In 1844, a 22-year-old German immigrant named Henry Lehman stepped onto the dusty streets of Montgomery, Alabama, with a simple dream to build a new life by opening a small general store. He could never have imagined that his humble shop, trading farming tools for raw cotton, would become the seed of a global financial empire. Nor could he have fathomed that 158 years later, the firm bearing his name, Lehman Brothers, would collapse in the largest bankruptcy in U.S. history, triggering a worldwide economic meltdown and becoming a global byword for corporate greed. This is the epic story of that rise and that fall. It's a journey that begins with three brothers, Henry, Emmanuel, and Mayer, transforming their cotton brokerage into a Wall Street powerhouse that would finance the railroads, department stores, and technologies that built modern America. We'll see its golden age under the legendary Robert Lehman, a titan who turned the firm into a symbol of prestige and power, and we'll witness its final tragic chapter under its last CEO, Richard Fuld, whose relentless ambition and appetite for risk drove the firm to unprecedented heights before plunging it and the world into financial chaos. Before it was a symbol of failure, Lehman Brothers was the embodiment of the American dream. To understand how that dream turned into a nightmare, we have to go back to the beginning, to that small shop in the heart of the Deep South, where a young man saw a future in the white gold of the cotton fields. The story begins in 1844 when a 22-year-old German immigrant named Henry Lehman opened a small general store in Montgomery, Alabama. Soon after, his two younger brothers, Emmanuel and Mayer, joined him in America, and together they founded Lehman Brothers. They quickly realized the real money wasn't in selling farm tools, but in trading the South's white gold, cotton. From a small shop, they transformed into powerful commodity brokers, building a reputation on honesty in a world where a man's word was his bond. The firm even survived the Civil War, a testament to their resilience, by having one brother, Emmanuel, manage their New York office in the Union North, while another, Mayer, ran their Alabama operations in the heart of the Confederacy. After the war, recognizing that the future lay not in cotton, but in industry, they made a strategic move, relocating their headquarters to New York City. This was the rebirth of Lehman Brothers. They pivoted from trading physical goods to financing the construction of modern America. They funded the railroads stretching across the continent and backed the rise of iconic consumer brands that would define the 20th century like Sears, Roebuck and Company, and Macy's. The decisive moment came in 1887 when Lehman Brothers purchased a seat on the New York Stock Exchange. They had officially entered the inner sanctum of American finance. The sons of a Bavarian cattle merchant were now titans of Wall Street, ready to enter the new century as a financial powerhouse. As the 19th century drew to a close, a new generation began to take the reins. Philip Lehman, Emmanuel's son, guided the firm into the 20th century. Philip was a different kind of leader. He was more formal, more reserved, and he had a vision of transforming Lehman from a partnership focused on commodities and brokerage into a full-fledged underwriting powerhouse. He saw the future in the rise of a new American phenomenon, the consumer. While other banks were focused on heavy industry like railroads and steel, Philip looked at the companies that were changing how ordinary people lived their lives. This led to one of their most famous and successful early underwritings. In 1906, Philip Lehman formed a partnership with his friend Henry Goldman of Goldman Sachs. Together, they took a fledgling but rapidly growing mail-order company public, Sears, Roebuck and Company. At the time, this was a risky move. Retail was seen as less prestigious than industry. But Philip and Henry saw the potential of a company that could sell goods directly to millions of Americans in rural areas through its famous catalog. The initial public offering was a massive success, and it cemented Lehman's reputation for having a keen eye for emerging growth companies. They followed this up with other landmark consumer-focused deals, like the IPO for F.W. Woolworth Company in 1912, the original five-and-dime store that was spreading across the country. They financed a dizzying array of iconic American brands: B.F. Goodrich tires, Underwood typewriters, R.H. Macy and Company department stores. Each deal was a testament to their ability to see the future. They weren't just providing capital, they were shaping the very fabric of American consumer culture. But Philip's greatest legacy would be the man he groomed to succeed him, his son, Robert Lehman, known to all as Bobby. Robert Lehman was, in many ways, the culmination of the family's American dream. He was born into immense wealth and privilege, a world away from the dusty streets of Montgomery. He was educated at Yale and became a partner at the firm in 1921. When his father Philip retired in 1925, Robert, at the age of just 33, became the head of Lehman Brothers. He would lead the firm for the next 44 years, a period that would become its undisputed golden era. Robert was a true Renaissance man. He was a brilliant and intuitive financier, but his passions extended far beyond Wall Street. He was a renowned art collector, amassing one of the most important private collections in the world. He was a sportsman, a horseman, who owned a successful racing stable. He was a man of immense style, taste, and influence. Under his leadership, Lehman Brothers was not just a bank. It was an extension of his own personality, sophisticated, daring, and always at the center of the action. He led the firm through the Roaring Twenties, a period of wild speculation and excess. Lehman was at the heart of it, creating investment trusts that allowed the public to invest in the booming stock market. But unlike many of their rivals, they managed to survive the Great Crash of 1929 and the devastating Great Depression that followed. They did it through shrewd management, a diversified portfolio, and Robert's uncanny ability to sense shifting tides. While other firms collapsed, Lehman endured. In the post-war era, Robert Lehman steered the firm into the new frontiers of technology and entertainment. He saw the potential of air travel and became a major financier for groundbreaking companies like Pan American Airways, which was pioneering international travel, and American Airlines. He understood the power of the new medium of broadcasting and backed David Sarnoff's Radio Corporation of America, RCA. He even ventured into the glamour of Hollywood, providing crucial financing for studios like RKO Pictures and 20th Century Fox. He was a venture capitalist before the term even existed, betting on the innovators and dreamers who were building the modern world. The firm under Robert was a unique place. It was still a private partnership, a tight-knit club of powerful men. Robert ruled it with an iron fist, but also with a touch of class. He was known for his sharp mind, his quick decisions, and his loyalty to those who performed. The firm became a magnet for the brightest minds in finance. A partnership at Lehman Brothers was one of the most coveted prizes on Wall Street. The firm's culture reflected its leader. It was aggressive but cultured, fiercely competitive but with an air of old-world gentility. From the 1920s to the 1960s, Lehman Brothers was at the absolute zenith of its power and prestige. It had transformed from a humble cotton brokerage into a global financial institution, a testament to the vision and tenacity of a single family. Robert Lehman, the grandson of a German immigrant, had become a king of Wall Street. the patriarch of a financial dynasty. The future seemed limitless, the empire unassailable, but the golden era was inextricably tied to the man who built it. And as Robert aged, a question began to loom over the firm. What would happen to Lehman Brothers without a Lehman at the helm? The death of a king is always a perilous moment for an empire. When Robert Lehman passed away in 1969, it was more than just the end of a life. It was the end of an era. For 44 years, he had been the undisputed autocrat of Lehman Brothers, the sun around which the entire firm orbited. His word was law. His vision was the firm's direction. He was the last Lehman to run the company, and his death created a power vacuum that would plunge the firm into a decade of bitter internal conflict. The sophisticated, unified culture that Bobby had so carefully cultivated began to fracture, revealing a deep and simmering divide that had long been kept in check by his immense authority. It was a clash of titans, a battle for the soul of Lehman Brothers itself. On one side were the investment bankers. These were the gentlemen of the firm, the white-shoe, Ivy League-educated financiers who specialized in advising corporations on mergers and acquisitions and underwriting stock offerings. They saw themselves as the rightful heirs to Robert Lehman's legacy, the guardians of the firm's prestigious relationships and reputation. Their world was one of mahogany-paneled boardrooms, quiet negotiations, and long-term client relationships. Their leader was Pete Peterson, a brilliant and politically connected man who had served as Secretary of Commerce under President Nixon. He was cerebral, statesmanlike, and believed in a more modern, structured corporate governance for the firm. Peterson was the embodiment of the old Lehman, cultured, connected, and convinced that the firm's strength lay in its advisory business and its sterling reputation. On the other side were the traders. These were the animals, the street-smart, aggressive, and often profane masters of the trading floor. Their world was a chaotic cacophony of shouting, ringing phones, and blinking screens. They didn't care about long-term relationships. They cared about the next minute, the next trade. They made money not by advising, but by betting the firm's own capital on the volatile movements of the market. They saw the bankers as stuffy, entitled, and out of touch with the real source of the firm's profits. Their undisputed king was Louis Glucksman, a gruff, cigar-chomping trader who had clawed his way up from the back office. Glucksman was Peterson's polar opposite. He was a product of the trading floor's meritocracy, a place where profits, not pedigree, determined a man's worth. He famously quipped, "The difference between a trader and an investment banker is that a trader has no sense of humor, and an investment banker has no sense of humor and no sense of smell." The line, though meant as a joke, captured the deep-seated cultural animosity that was about to boil over. In the immediate aftermath of Robert Lehman's death, the firm was run by a committee, a rudderless arrangement that only exacerbated the tensions. By 1973, it was clear that a singular leader was needed. In a compromise that satisfied no one, the board appointed Pete Peterson as chairman and CEO, but made Lou Glucksman his president and COO. It was a forced marriage, an attempt to appease both the banking and trading factions. For a time, the arrangement worked, at least on the surface. The 1970s were a difficult period for Wall Street, marked by stagflation and a bear market, but Peterson and Glucksman managed to steer Lehman to profitability. Peterson, with his Washington connections, brought in prestigious advisory deals. Glucksman, with his iron grip on the trading floor, generated consistent profits from the firm's market-making activities. But beneath the surface, the resentment festered. The traders, led by Glucksman, felt they were the firm's engine, generating the lion's share of the profits, yet they were treated like second-class citizens. The compensation structure in particular was a major point of contention. The bankers were rewarded through the traditional partnership model, where profits were shared based on seniority and relationships. The traders, however, wanted to be paid directly for the profits they generated. They wanted a system of eat what you kill, where a trader who had a spectacular year would receive a spectacular bonus regardless of his title or tenure. Glucksman constantly fought for his people, demanding bigger bonuses and a greater share of the firm's resources for the trading division. The bankers saw this as greedy and short-sighted, a threat to the firm's long-term stability. The tension finally reached its breaking point in 1983. The markets were roaring back to life, and the trading division was having a phenomenal year, on track to deliver over 80% of the firm's total profits. Glucksman saw his chance. He felt that he and his traders had saved the firm and deserved to be in control. He went to the board and delivered an ultimatum. Either he be made sole CEO, or he and his entire trading division would walk out the door. It was a breathtaking power play. A mass walkout by the traders would have instantly destroyed the firm. The bankers were caught completely off guard. They had underestimated Glucksman's ambition and the fierce loyalty he commanded. The boardroom battle was swift and brutal. Peterson, the polished statesman, was no match for Glucksman's raw aggression. Seeing that he had lost the support of the board, which was terrified of losing its profit engine, Peterson resigned. In July 1983, Louis Glucksman, the trader from the back office, was named the sole chairman and CEO of Lehman Brothers. The coup was complete. The animals were now running the zoo. Glucksman's victory was a watershed moment, not just for Lehman, but for all of Wall Street. It signaled the definitive shift in power from the relationship-driven world of investment banking to the profit-driven, high-risk world of trading. But for Glucksman, the taste of victory would be fleeting. He had won the war for control, but his timing could not have been worse. Almost as soon as he took the helm, the markets turned against him. The fierce infighting had taken its toll, and many talented partners loyal to Peterson began to leave. Furthermore, the massive bonuses Glucksman had promised his traders during the coup were now coming due, draining the firm's precious capital at a time when profits were shrinking. The firm, which had been so profitable just a year before, was now hemorrhaging money. Glucksman, the brilliant trader, found that running a firm was a very different challenge from running a trading desk. Within a year of his triumphant coup, Lehman Brothers was on the brink of collapse. Facing a desperate situation, Glucksman was forced to do the unthinkable. He had to find a buyer. He had fought so hard to win Lehman's independence, only to be forced to sell it to survive. The white knight that emerged was American Express, led by its ambitious CEO, James Robinson III. Robinson had a grand vision of creating a financial supermarket, a one-stop shop where a customer could have a credit card, get a mortgage, buy stocks, and receive corporate finance advice, all under the iconic Amex brand. He had already acquired Shearson, a massive retail brokerage firm, and saw the prestigious Lehman Brothers brand as the final jewel in his crown. In 1984, American Express acquired Lehman Brothers for $360 million. The 134-year-old partnership was no more. The firm was merged with Shearson and became Shearson Lehman / American Express. For the proud partners of Lehman, it was a humiliating end, a surrender of their identity. The 10 years that Lehman spent as a division of American Express are often referred to as the wilderness years. The promised synergies of the financial supermarket never materialized. Instead, it was a culture clash of epic proportions. The aggressive, entrepreneurial, risk-taking culture of Lehman traders was utterly incompatible with the slow, bureaucratic, and brand-conscious culture of American Express. The Lehman partners, who were used to making multi-million-dollar bets in a split second, now found themselves bogged down in endless committee meetings and corporate red tape. They resented being a small cog in a massive impersonal machine. James Robinson and the Amex executives, in turn, were often horrified by the traders' seemingly reckless behavior and their astronomical bonus demands, which they saw as a threat to the conservative American Express brand. Many of the top talents from both the banking and trading sides left, disgusted with the new environment. The firm lost its focus, its identity, and its edge. It was a painful and frustrating decade. But within the sprawling bureaucracy of Shearson Lehman, a core group of Lehman loyalists endured. They were the true believers, the ones who had stayed through the turmoil, dreaming of the day when Lehman could be Lehman again. Their unofficial leader was a man who had been a loyal soldier to Lou Glucksman, a man who had started his career at Lehman in 1969 and had never worked anywhere else. He was a tough, uncompromising bond trader with a ferocious temper and an even more ferocious sense of loyalty to the firm. His name was Richard S. Fuld, Jr. By the early 1990s, it was clear that the American Express experiment had failed. A new CEO, Harvey Golub, took over at Amex and decided to dismantle the financial supermarket. His strategy was to refocus on the company's core credit card and travel businesses. The brokerage and investment banking divisions were a distraction and a drain on resources. In 1994, Golub made the decision to spin off Lehman Brothers as an independent, publicly traded company. For Dick Fuld and the other Lehman veterans, this was their moment of liberation. They were finally free. Fuld, who had risen through the ranks to become the head of the fixed income division, was the natural choice to lead the newly independent firm. He was named chairman and CEO of Lehman Brothers Holdings Incorporated. This was not just a job for Fuld, it was a crusade. He saw it as his personal mission to restore Lehman to its former glory, to avenge the humiliation of the Amex years, and to prove to the world that Lehman was one of the greatest firms on Wall Street. He carried a massive chip on his shoulder, and he instilled that same us against the world mentality throughout the entire organization. His management style was legendary for its intensity. He demanded absolute loyalty and punished any hint of dissent. He was nicknamed the Gorilla for his intimidating presence and aggressive demeanor. He once famously told his rivals that he wanted to reach into their chests, pull out their hearts, and eat them before they die. This was the man now in charge of Lehman's destiny. Fuld's strategy was simple and aggressive. He would rebuild Lehman in the image of the division that he knew best, and that had always been the firm's profit engine, trading, specifically fixed income trading. While other firms like Goldman Sachs and Morgan Stanley maintained a balance between investment banking and trading, Fuld made a conscious decision to bet the firm's future on the high-risk, high-reward world of the bond markets. The newly independent Lehman was lean, mean, and hungry. Fuld fostered a cult-like culture where employees were pushed to their limits. Long hours and immense pressure were the norm, but the rewards were astronomical. The firm's compensation structure was heavily skewed towards bonuses, creating a powerful incentive to take risks and generate short-term profits. Throughout the late 1990s and into the new millennium, Fuld's strategy seemed to be a spectacular success. The firm thrived, riding the wave of a long bull market and the explosion of financial innovation. Fuld made a particularly big bet on a new and incredibly profitable area: securitization. This was the process of taking illiquid assets, like mortgages, bundling them together into a bond, and selling that bond to investors. These were called mortgage-backed securities, MBS. At first, they were mostly created from prime mortgages, loans made to borrowers with good credit. But as the housing market began to heat up in the early 2000s, Wall Street's appetite for these securities became insatiable. To feed this demand, Lehman and other banks pushed into the subprime mortgage market, loans made to borrowers with poor credit histories and a higher risk of default. Lehman didn't just want to be a middleman in this business. It wanted to control the entire supply chain. In 2003 and 2004, they went on a buying spree, acquiring several subprime mortgage originators, most notably BNC Mortgage and Aurora Loan Services. Now, they had their own dedicated factories churning out the raw material, the subprime loans, that their trading desks in New York and London could package into ever more complex securities. They created not just MBS, but also collateralized debt obligations, CDOS, which were fantastically complex instruments created by slicing and dicing different mortgage-backed securities into new bonds with different levels of risk and reward. These securities were often given AAA ratings, the highest possible rating for safety, by the credit rating agencies, which were paid handsomely by the banks to rate them. It was a dizzyingly profitable business. The profits from the mortgage machine were immense, and they fueled record earnings for Lehman year after year. The firm's stock price soared from just a few dollars after the spinoff to a peak of over $85 per share in early 2007. Dick Fuld was hailed as a Wall Street genius. He had taken a broken, discarded firm and turned it into the fourth largest investment bank in the United States, a global powerhouse that was now competing head-to-head with Goldman Sachs. The culture inside Lehman became one of supreme confidence, bordering on arrogance. They believed they were the smartest guys in the room. They had developed sophisticated mathematical models that, they believed, allowed them to perfectly manage the risks of their massive mortgage portfolio. Key lieutenants like President Joe Gregory and later Chief Financial Officer Aaron Callan became stars in their own right, the public faces of a firm that seemed to have found the secret to perpetual profits. Fuld ran the firm with an iron grip. He surrounded himself with a tight circle of loyalists who would never dare to question his judgment. Dissent was seen as weakness, as a lack of commitment to the team. This created a dangerous echo chamber where bad news was suppressed and warning signs were ignored. As the housing bubble inflated to epic proportions, Lehman kept doubling down. They weren't just creating and selling mortgage securities anymore. They were holding vast quantities of them on their own books, particularly the riskiest, lower-rated tranches that no one else wanted to buy. They also made huge investments in commercial real estate, buying up entire office buildings and development projects at the very peak of the market. The firm's leverage, the amount of money it borrowed relative to its own capital, soared to unprecedented levels, reaching over 30-to-1. This meant that for every dollar of its own money, it had borrowed 30 more. This leverage magnified profits on the way up, but it would also magnify losses catastrophically on the way down. By 2007, Lehman Brothers stood at the apex of its power and prestige, a monument to the aggressive, risk-taking culture that Dick Fuld had built. It was a global financial titan with record revenues and a market capitalization of over $45 billion. Fuld himself was one of the highest-paid CEOs on Wall Street, the undisputed king of his domain. From the ashes of the Amex years, he had forged an empire. It seemed unstoppable, invincible. But in the world of finance, pride often comes before the fall. Unseen by the cheering crowds and the soaring stock charts, tiny cracks were beginning to appear in the very foundation of their glittering palace. The subprime mortgage market, the engine that had powered their incredible rise, was starting to sputter, and the gorilla of Wall Street, who had vanquished all his enemies, was about to face a foe he could not intimidate, could not control, and could not defeat: reality. The first tremor hit in the summer of 2007. Two hedge funds run by a rival investment bank, Bear Stearns, suddenly collapsed. The reason? They were loaded with toxic subprime mortgage securities. It was the canary in the coal mine, a clear signal that the seemingly safe AAA-rated mortgage bonds were in fact incredibly risky. The news sent a ripple of fear through the financial system. For the first time, Wall Street was forced to confront the possibility that the housing boom was over, and that the complex securities built upon it were a house of cards. At Lehman's headquarters, the official response was one of calm assurance. Dick Fuld and his top executives publicly dismissed the Bear Stearns incident as an isolated event, a case of poor risk management by a competitor. They insisted that their own models were superior, that their positions were well hedged, and that the problem was, in their now infamous word, contained. But behind this facade of confidence was a fatal miscalculation born of pure hubris. Instead of seeing the warning signs and pulling back, Fuld and his team saw the falling prices of mortgage assets as a massive buying opportunity. They truly believed they were the smartest guys in the room, and that while others panicked, they could swoop in and buy up these assets on the cheap, positioning themselves for massive profits when the market inevitably rebounded. And so, as 2007 turned into 2008, while the rest of the world was waking up to the scale of the crisis, Lehman Brothers did the unthinkable. They doubled down. They continued to accumulate billions of dollars in toxic commercial and residential real estate assets, vastly increasing their exposure to the very market that was collapsing around them. It was the gambler's fallacy on a corporate scale, a belief that after a string of losses, a win was just around the corner. As their losses mounted, they resorted to increasingly desperate measures to conceal the true state of their financial health. Their most notorious tool was a controversial accounting maneuver known as Repo 105. In a normal repo transaction, a firm sells assets to another party with an agreement to buy them back shortly thereafter, typically the next day. It's essentially a short-term loan, and under accounting rules, it must be treated as such, meaning the debt stays on the balance sheet. But Lehman found a loophole. By using a London-based subsidiary and structuring the transactions in a specific way, they were able to argue, based on a questionable legal opinion, that if the value of the assets sold was at least 105% of the cash received, the transaction could be classified as a true sale. This meant they could temporarily move tens of billions of dollars in assets off their balance sheet right at the end of a financial quarter, making their leverage ratios look significantly healthier than they actually were. A few days into the next quarter, they would quietly buy the assets back. It was a form of financial window dressing, a maneuver that the post-bankruptcy investigation would later conclude was a deliberate act of deception designed to mislead investors, rating agencies, and the public about the true level of risk the firm was carrying. The real earthquake struck in March 2008. Bear Stearns, the fifth largest investment bank, found itself on the verge of a catastrophic collapse. A classic bank run had begun as clients and trading partners, fearing for the firm's solvency, pulled their money and refused to do business with them. Over a single terrifying weekend, the U.S. Federal Reserve and the Treasury Department orchestrated a forced rescue, brokering a sale of Bear Stearns to J.P. Morgan Chase for a fire sale price of just $2 a share, a price later raised to $10. The government even agreed to backstop $30 billion of Bear's worst assets to facilitate the deal. This was an unprecedented intervention. It sent a clear message to the market. Some institutions were indeed too big to fail, and the government would step in to prevent their disorderly collapse. For Lehman Brothers, the fall of Bear Stearns was a death knell. A massive spotlight now swung onto them. The market knew that Lehman, like Bear, had enormous exposure to toxic real estate assets. The question on everyone's lips was, who's next? And the resounding answer was Lehman. The short sellers began to circle like sharks smelling blood in the water. Most prominent among them was David Einhorn, the head of the hedge fund Greenlight Capital. In a series of devastating public speeches, Einhorn meticulously dismantled Lehman's financial statements, accusing them of using accounting tricks like Repo 105 and questioning the value of their hard-to-price assets. His detailed, credible attacks shattered what was left of Lehman's credibility and accelerated the crisis of confidence. A death spiral began. Lehman's stock price plummeted. Its credit default swaps, a form of insurance against its default, soared, making it prohibitively expensive for others to do business with them. Fuld and his team were in a desperate race against time to raise capital and restore confidence. In June, they announced a shocking $2.8 billion second quarter loss, the first in their history as a public company. In a desperate shakeup, Fuld fired his two top lieutenants, President Joe Gregory and CFO Aaron Callan, but the move did little to calm the markets. They spent the summer of 2008 in a frantic, globe-trotting search for a savior, for an investor who would inject the billions needed to shore up their balance sheet. Their last best hope was the Korean Development Bank, KDB. Weeks of tense negotiations ensued, but in the end, the Koreans walked away, reportedly due to disagreements over price and pressure from their own regulators. The news that the KDB talks had failed was a fatal blow. Lehman was running out of options and running out of time. The final act of the drama unfolded over the weekend of September 12, 2008. The setting was the imposing headquarters of the Federal Reserve Bank of New York in downtown Manhattan. Treasury Secretary Henry Hank Paulson, the former CEO of Lehman's arch-rival Goldman Sachs, and Tim Geithner, the president of the New York Fed, summoned the CEOs of every major Wall Street bank for an emergency summit. The atmosphere was grim. Dick Fuld was notably not invited into the main meetings, left to pace in a separate office, a pariah waiting for others to decide his firm's fate. Paulson laid down the law in no uncertain terms. After the public backlash over the Bear Stearns rescue, there was zero political appetite for another government bailout. He was drawing a line in the sand. There would be no public money used to save Lehman Brothers. The only solution would be a private one. The assembled bank chiefs were told, in essence, to find a buyer or a way to collectively bail out the firm themselves, or else face the consequences of a Lehman collapse on Monday morning. The negotiations were frantic and sleep-deprived. The bankers pored over Lehman's books and were horrified by what they found, a black hole of toxic, impossible-to-value real estate assets. Bank of America, one of the leading candidates to buy Lehman, abruptly pulled out of the talks on Sunday morning and announced its intention to buy Merrill Lynch instead, which was seen as a much healthier firm. The last and only hope was Barclays, the British banking giant. A deal was hastily hammered out. Barclays would buy Lehman's good assets, leaving the bad ones behind. For a few hours on Sunday, it seemed like a solution had been found. But then, a fatal call came from across the Atlantic. British regulators, including the Chancellor of the Exchequer, refused to approve the deal. They would not allow a British bank to import what one official called Lehman's cancer and put their own financial system at risk, especially not without a financial guarantee from the U.S. government. Paulson, sticking to his no bailout pledge, refused. The Barclays deal was dead. There were no other buyers. There were no other options. At that moment, everyone in the room knew it was over. The decision was made. Lehman Brothers would be allowed to fail. On the morning of Monday, September 15, 2008, Lehman Brothers, a firm that had survived the Civil War, 2 World Wars, and the Great Depression, filed for Chapter 11 bankruptcy. This was not a contained event. It was the detonator for a global financial meltdown. Lehman was so deeply intertwined with every other financial institution that its failure caused a catastrophic chain reaction. A massive money market fund, supposed to be as safe as cash, broke the buck because of its Lehman debt, causing a panic-driven run on similar funds. The credit markets, the lifeblood of the modern economy, froze solid. Companies could no longer borrow to make payroll or pay suppliers. The world's financial system went into cardiac arrest. Just 24 hours after letting Lehman fail on principle, the U.S. government was forced into an emergency $85 billion bailout of the insurance giant AIG, realizing its collapse would be an extinction-level event. This inconsistency created chaos and panic. To prevent a complete economic collapse, the U.S. government launched TARP, a $700 billion bailout for the entire banking system. But it was too late to stop the Great Recession, the worst economic downturn since the 1930s, which cost millions of people around the world their jobs, homes, and life savings. The Lehman name, once a symbol of prestige, became forever synonymous with greed, arrogance, and disaster. The collapse led to sweeping new financial regulations like the Dodd-Frank Act, designed to ensure such a crisis would never happen again. Ultimately, the story of Lehman Brothers is a modern-day Greek tragedy. It begins with an immigrant's American dream and ends in a global nightmare. It is a costly lesson about the dangers of unchecked leverage, the failure of risk management, and a culture that valued short-term bonuses over long-term stability. It serves as a chilling reminder that no empire, no matter how powerful, is too big to fail.